Something very concerning is building up behind the scenes when it comes to government and consumer debt, something so bad it could cripple the US economy for the next decade if it is not resolved. Economists and even government-based forecasting organisations have issued their warnings already, and today I'll be taking a deeper dive into what exactly is going on with this US debt problem and the potential consequences it could have on not just the US economy, but the global economy as well. Now, debt is not always a completely bad thing, and a certain level of federal debt can be a good thing for a country's economy as it can stimulate the economy and lead to economic growth. However, if debt continues to rise too much, it can reach a point where it is causing more harm than good and can be a dangerous thing. This can apply on a government level when it comes to federal debt having a negative impact on a country's economy, or on a corporate level as well, where debt that a company has taken on is starting to harm the business. Now, in a wide range of historic studies, economists generally agree that when debt reaches a range of 80 to 90% of GDP, it can become problematic for an economy, with the impacts being a net negative. Total public federal debt has been rising steadily over the last 50 years or so. However, over the last few years, since 2020, we have seen a real surge in public debt, pushing the total figure to over $31 trillion. Now, this does put the total government debt at 120% approximately of national GDP, which is an alarmingly high percentage and is much higher than the historical norm. Now, the only time we've been this high before was back during the pandemic, where obviously GDP was hit massively due to the economy shutting down. But looking back at before this, in 2019, we were at debt levels of around $22 to $23 trillion, with this being only 105% of national GDP. Now, that means that the total federal public debt has increased by a staggering 42.7% in just 3 years, an unprecedented rise in debt. And what makes this even more problematic is that the US has now reached their debt ceiling, a legal limit set by Congress on how much the federal government can borrow. It was only December of 2021 when this debt limit was extended to $31.4 trillion, and the government now needs it to be raised again if it is to avoid defaulting on its payments in the near future, with their remaining cash on hand falling under $400 billion. So in order to generate additional borrowing capacity and stretch out its remaining cash, US Treasury Secretary Janet Yellen has said that new investments in various government accounts will be suspended and amendments will be made to the Thrift Savings Plan for federal employees, which invests in non-marketable securities that mature on a daily basis. But once initial measures are exhausted, the Treasury may need to prioritise certain debt payments over others, mainly being interest and principal payments on their debt. And this could put certain programs at severe risk, which does include Social Security, federal salaries, as well as healthcare coverage for military personnel and other veteran benefits. Analysts do believe that the US could run out of cash and completely default on payments by the end of the summer, which is very concerning to hear, and JP Morgan analysts do believe that the Treasury could create an additional $450 billion in borrowing capacity in the coming months, which would mean a default would be pushed back until around November time. So the chances of a new debt limit being passed are far from guaranteed, and in fact analysts do believe that there is a very real chance that any must-pass legislation is at risk of being held hostage by Republicans controlling the House of Representatives, who could use the debt ceiling situation as leverage for other policy changes. So investors are therefore starting to worry about the very real possibility of a US debt default, which is something that has never happened before and could completely upend the whole economy. The extraordinary measures that would have to be acted on if the debt ceiling cannot be raised would likely plunge the US into a deep recession. Debt can be a powerful tool for governments to use in order to stimulate economic growth in the economy, and the US government's loss of ability to use this tool could have a devastating impact on the US economy's growth over the coming years. And even assuming that the debt ceiling does get raised, that doesn't mean that everything is going to be all fine and dandy from here on out into the future. In fact, judging by what the Congressional Budget Office themselves have published earlier this month, we are already locked into a debt problem that is rapidly spiralling out of control and totally unsustainable in the long run. Now, looking at this graph that the CBO has published, it is projected that public debt will rise by a further 20% over the next 10 years to reach 118% of GDP in the year 2023, which is on average 2% increase a year. Now, over this period, the growth of interest payment costs and mandatory spending on the likes of healthcare programs and social security will outpace the growth of revenues and the economy in general, driving up debt. Now, those factors are likely to remain beyond 2033, according to this report, continuing to push the federal debt even higher until it will reach an estimated 195% of GDP by the year 2053. The key problem is that the US government just cannot get to a point where they have a net depository surplus, meaning that they have to keep borrowing more and more money every year because they are in a deficit. And to put it simply, every year they are spending more money than they earn from tax. Now, currently the government is operating at a deficit that is approximately 5% of GDP. However, the Congressional Budget Office once again has a negative outlook on how this will change in the future, forecasting this deficit to grow closer to 10% of GDP every year going forwards. And this repeated budget deficit can quickly become a downwards debt spiral if something drastic is not done soon. Now, this is because as of 2022, the government is spending 8% of their budget on interest payments for existing debt that they already have, but every time that they are in a budget deficit, then more debt does get piled on top of this. And therefore, this interest payment expenditure is growing every year as the debt continues to grow. And soon we could be seeing interest payment expenditure become a larger spending category than the education, training, employment and social services category, the Medicare category, or even national defense. And it's not just the US government that has big debt problems. The US population has also been accumulating debt at a rapid pace in recent years as well, with consumer debt reaching new highs. Now, US consumer credit card debt spiked 7% in Q4 of 2022, hitting a new high of $986 billion, meaning that the first quarter of 2023 is almost certainly going to take us over the $1 trillion threshold. Now, Morgan Stanley do estimate that in just last year alone, consumers spent 30% of the $2.7 trillion in excess savings that were built up during the pandemic, with lower income consumers reaching closer to 50% of this. And they also do estimate that consumers will spend another $500 billion of their pandemic savings in 2023. Now, many people got used to having an abundance of cash during the pandemic, benefiting from numerous stimulus checks that were sent out, and also not having too much to spend their money on during lockdowns. And having all of this cash laying around led to consumer spending soaring once the economy did fully reopen again over a year ago. However, it has since dried up and many consumers are having a hard time readjusting to their old spending habits. And as of today, prices are very high due to soaring inflation, and general cost of living is much higher than it used to be, and therefore savings have been depleted for many people across the US. And this has therefore caused many people to turn to credit cards in order to continue financing their lavish post-pandemic spending habits. Credit card debt, despite usually being the most dangerous type of consumer debt due to how high the interest rates tend to be, is only one component of non-housing consumer debt, and we have been seeing these other types of debt expand as well. Now, this does include auto loans, student loans, as well as any other types of debt, which collectively with credit card debt have surged in recent time and are now at a whopping $4.64 trillion altogether. Housing debt has also been on the rise in recent years due to the rises that we've seen in both the housing market as well as the interest rates and mortgage rates. Although housing debt in the form of mortgages is generally considered to be a safer and more essential type of debt in comparison to the various non-housing debts that we have. But zooming right out and adding together housing and non-housing debt, we can see that the total debt balance for US consumers is now $16.9 trillion. And to make matters worse, while consumer debt has been rising, the personal saving rate is simultaneously declining and is now at just 4.7%, despite a slight uptick since the new year. Now, this means that consumers are on average saving just 4.7% of their income, which is far less than we've seen in most historic time periods. And in fact, you'd have to go back to just before the global financial crisis to find a time where the personal saving rate did reach this low. The personal saving rate pre-pandemic was around 9%, almost double the amount that we are seeing today, showing just how little people are saving compared to just a few years ago, due to both changing spending habits as well as the cost of living crisis squeezing people to the limit. The housing market is also in real trouble, and we could be on the verge of a massive housing market crash looking at recent data. To check out the detailed video that I made on this topic recently, then click on the screen right now. Aside from that, leave a like on the video if you did enjoy it, that does help out a lot. Also be sure to comment, let me know what your thoughts are on the current debt situation and how you think this will pan out. Be sure to subscribe as well if you want to see more videos similar to this in the future, and apart from that, thanks a lot for watching.